think are that we have a lot of central bank buying now because of the weaponization of the US dollar due to the stupidity of sanctions that have been placed.
So the calculation is, hey, let me hold my savings in gold rather than dollars. So those three functions, I think, are really placing a strong bid, um, and an enduring bid in gold, and I think it's going much higher over the years.
The gold market continues to hold above the $3,000 mark, but recent profit-taking has led to a slight retreat, with prices struggling to maintain levels above $3,057 an ounce. While some investors may see this as a temporary setback, many analysts argue that a period of consolidation at these levels is both expected and necessary for a sustainable long-term uptrend. Spot gold was last seen trading at $3,014.20 per ounce, down nearly 1% for the day, yet still reflecting a solid 1% gain from the previous week. Given the rapid ascent of gold in recent months, short-term corrections are not unusual, especially as investors take profits and reassess their positions. However, with continued economic uncertainty and strong central bank demand, Steve Hanke, a respected economist, believes that gold could hover around $3,000 for the next several months as markets adjust to this new price range. He suggests that a gradual climb beyond this level would indicate a more sustainable breakout rather than a short-lived surge. While Hanke does not anticipate immediate new highs, he also sees limited downside risks, given ongoing concerns about inflation and global financial stability. Analysts argue that any pullback should be seen as a potential buying opportunity rather than a sign of weakness in the broader trend. Hanke Pento, a market strategist, also sees the potential for gold to retrace slightly without disrupting its overall bullish momentum. He points out that a drop of around $100 would not be unusual and could even strengthen gold's long-term outlook by shaking out weaker hands before the next leg higher. The key support level he is watching sits at $2,955, a critical point that marked last month's high before gold's latest breakout. With stagflation fears mounting, many institutional investors could take advantage of any dip to increase their gold allocations. We present the clips from interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
So the most important function when it comes to the future price of gold is the level of real interest rates. So the Fed's hands are tied because, as I mentioned, inflation's stubbornly stuck around 3%. And you have falling nominal rates, so real interest rates are falling. That's the strongest impetus to higher prices in gold. And then you have things like rumors that the Treasury is going to revalue the gold on its balance sheet to $3,000 an ounce from where it sits currently, which is very, very low. I forgot the number now, but I think it's like 20,
$42.22.
$42. So if it gets revalued, it's an automatic seven. Now, first, and this is where it gets really crazy. So if the Treasury revalues its gold to what would be about $750 billion if they revalue its gold, somehow that entitles the Fed to then hand the Treasury $750 billion in the Treasury general account, which would be a massive QE program. I don't know if that's going to happen or not, but the rumor is out there. I keep hearing it. I have no insider information on that whatsoever. I think that would be a really bad thing to do. But who knows with these maniacs? I also thought handing trillions of dollars out to people so they can stay home and mail them, a total of $6 trillion of checks in the mail is a really bad idea too. So what do I know? So there are other reasons too. The end of the dollar is the world's reserve currency. If you do end our trade deficit with overseas nations, then you're also reducing your capital account surplus, which means there'll be less dollars that foreigners need to hold, and would be less recycled into our bond market and into our treasury complex and into out of dollars and into gold. So gold is replacing the dollar as the world's reserve currency, and I think Steve mentioned sanctions too. It's just if you have your trade deficit recycled into dollars and held in the United States, and then the United States doesn't like you anymore, and then says, we're freezing your assets. That's a really bad deal, rightly or wrongly. So the calculation is, hey, let me hold my savings in gold rather than dollars. an enduring bid in gold, and I think it's going much higher over the years.
So one thing Michael said that's interesting. Well, he said a number of things that are interesting. One thing is that the real interest rate coming down, of course, gives wind to the sail of the bull market. But thinking about it, the real interest rate, we've had the bull market running up in the face of a lot of headwinds from high real interest rates and a record strong U.S. dollar. A strong dollar is usually a huge hindrance to gold, and so are high real interest rates. But in the face of those two headwinds, gold has actually gone up.
I think that's a great point, Steve. So that shows you, I mean, you don't disagree that falling real interest rates are great for gold.
I totally agree.
Yeah. So that means I think the gold market is like all markets is a forward predictor. And I think that these massive deficits, you have $2 trillion deficits in peacetime and in prosperity with near record low unemployment rate and record tight spreads, credit spreads at record tight spreads. Gold is telling you that the problems of debt monetization have just begun because we have no other alternative. We are going to default on our debt. And we're not going to explicitly default on our debt. We're going to implicitly continue to, and in greater magnitude, default on our debt implicitly, which is through inflation. I think that's one of the big drivers. A protracted driver of the price of gold is that we just have a deficit that's $2 trillion. The debt is 36 trillion, 125% of GDP and rising. There's no way around it but to monetize that debt. And that's a sustainable bull market in gold.
Steve Hanke emphasizes that inflation remains a significant driver behind gold's continued strength, as persistent price pressures erode the purchasing power of fiat currencies. Despite the Federal Reserve's efforts to contain inflation, core consumer prices remain elevated, making it unlikely that the Fed will maintain restrictive policies for much longer. If inflation proves more stubborn than expected, investors may increasingly turn to gold as a hedge, reinforcing its long-term uptrend. Historically, inflationary periods have led to surging gold prices, and with ongoing fiscal deficits and loose monetary conditions in play, the fundamental case for higher gold prices remains intact. Michael Pento highlights that the Federal Reserve's interest rate policy will be a crucial factor in shaping gold's trajectory. While markets have priced in potential rate cuts later in the year, any delay in easing monetary policy could create short-term volatility. However, a shift toward lower rates would weaken the U.S. dollar and increase gold's appeal as a non-yielding asset. Pento argues that if the Fed cuts rates aggressively to combat slowing economic growth, it could spark a renewed rally in gold. Given the delicate balance between inflation control and economic stability, investors remain highly attuned to the Fed's next moves, knowing that any dovish pivot could be the catalyst for another significant gold surge.
This backside, that the Fed somehow has your backside. And Michael gave us a lot of good contemporary evidence, but remember, did they have the backside of the American public in 1929, 1933 when the market went down 86%? No. So the other thing to forget is is that they know what they're doing. And that they have models at work. They never predicted the inflation that we recently had, or the decline that we've had. And Michael's right. They're still in this old Phillips curve model with a little more fancy stuff added to it with post-Keynesian models that don't even include a monetary aggregate. Now that gets down to where I'm coming from. In terms of national income determination, the only thing that really counts is the quantity theory of money. Changes in the money supply eventually will transmit themselves into changes in asset prices, changes in real economic activity, and changes in inflation. And that's with long and variable lags. So if we look at what's happened recently, first the Fed gooses the money supply. We eventually get a lot of inflation. Then they panic because they're looking at contemporary data. They see the inflation's getting hot. They throw things into reverse. And since the summer of 2022, the stock of money in the United States is actually less today than it was in the summer of 2022. Now, that kind of contractions only happened 4 times. A recession ultimately followed. Actually, one of the 4 times the Great Depression followed. Remember, that was a big one. From 29 to 33, the money supply actually collapsed by 38%, and bang, we went down. So where are we with what's baked in the cake? In other words, this year, what happens in terms of inflation is something that's a function of what happened to the money supply a couple of years ago. And a couple of years ago, it was what? It was going down. So I anticipate that the headline inflation will actually come in at 2% or maybe even a little below 2% this year. And that doesn't have anything to do with other things going on contemporaneously in the economy. It's something that happened in the past with the money supply. Now, as far as the inflation target goes, the inflation target, remember, the Reserve Bank of New Zealand put in the inflation target formally for the first time, I think in 1991, if my memory serves me correctly, and it was 2%, and everybody else just copied 2%. It's an arbitrary number. I mean, if I was having a number, I'd have 0.
Global central banks are expected to accelerate their gold acquisitions in the coming years as they seek to shield their reserves from geopolitical risks and financial instability. With over 1,000 metric tons purchased in 2024 alone, double the average of the prior decade, this trend shows no signs of slowing down in 2025, with major buyers like China, India, and Poland continuing to expand their holdings. The freezing of Russian central bank assets in 2022 served as a wake-up call, pushing nations to diversify away from fiat reserves vulnerable to political decisions. Gold, being immune to such restrictions, has become the asset of choice for safeguarding wealth and maintaining financial sovereignty. As global tensions persist and inflationary pressures mount, central banks are likely to deepen their gold reserves, reinforcing the metal's long-term bullish trajectory and diminishing the dominance of dollar-based holdings in global finance. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.